What's up, YouTube? Thank you guys so much for tuning back into another video. So today I'm going to be talking to you guys about the different market order types, what they are, and the when you will actually use each one. I've had a few subscribers ask me about this video. They need some clarification of when you will use these different order types. Apparently, there's a number of videos out online about these, but they aren't very clear. So hopefully this clears it up, and this provides a lot of clarity to you guys. So without further ado, let's just kind of hop right into this. First thing to remember with the market order types is that, oh, I should say stock market order types, is that you have one of two, it's one of two premises. One, you want to get in or out of the stock immediately, or you want to get in or out of a stock at a later time. So just keep that in mind. No matter what order type it is, it's either you want to get in or out of a stock immediately or in or out of stock at a later time. That's going to determine which order type you use. So, the most basic order type is the market order. Market order just basically says, I want in right now, give me in at the best ask price. That's it. With any time at all times during the market hours, even after hours, you have what's called a bid and an ask price. I won't get too down in the weeds, but just basically the bid price is the person who wants to bid on the stock. That's going to almost always be lower than the best ask price, which is the person that wants to sell the stock. Right in between that, that's the spread. It's usually a few cents, depending on how much demand the stock is in. But don't worry about all of that complicated stuff. Just know that there's a bid and there's an ask price. Typically, people want to try to get the best price on the bid side if you want to buy, or if you're selling it, you want to get the best price on the ask side, right? But when you hit a market order, you're saying, I don't care, get me in on the ask price, right? I'm willing to pay a few cents more to get in right now. And that's what it does. It executes right now on the spot. That's not a big deal unless you market orders aren't a big deal for investors. You can hit market orders all day long and you don't think twice. There's no point in doing anything else. If you are day trading, you will always use limit orders, almost always. You can use market orders, but if you're day trading, then you're trying to get, you're trying to trade for a few cents or, a few more cents, and that really can make a big deal, particularly because you have what's called slippage on a market order. And what that means is that when you hit a market order, you see the best ask price is at let's say 298, 94, whatever the ask price is. Well, you may actually get filled at like 298, 98 or 299, right? And that's called slippage. It's a huge deal for day traders, not a big deal for investors, or not even a big deal if you plan on holding or you anticipate a big swing. But that's a market order, just flat out. Next order type, limit order. This is the order type that you're going to use 99% of the time. At least I do. A limit order on the buy side means that you're going to wait until the price drops to the point that you're comfortable buying at. That's what that means. So right now it's at 298.88, and you're like, you know what? I want to buy when it gets down to 270. So you'll put a buy limit in at 270, and then you'll hit submit. Now you have what's called a day or good to close, good till canceled order. Basically, what that means is that if you have a time enforced on a day, this order will be enforced for the whole day until close of business at 3 o'clock Central or 4 o'clock Eastern Standard Time. After that, that order goes away. So if you wanted to buy the 270 and it doesn't hit 270 today, that order goes away. If you hit good till canceled, what that means is that that order is going to stay in effect indefinitely until you go in there and you actually cancel it. So just be mindful of that when you submit an order. All right, so that's what that buy limit is. The sell limit means that you want to sell a stock when it hits a certain price. So you're already in a stock, you already own it, and you're like, you know what? When it gets up to 320-ish, I don't know, 305, I want to go ahead and sell, take some profits because I just think it's a little overextended. So you'll go in there, you'll put in 305. You have your sell limit, right? You can choose extended hours as well if you want to sell after hours. Right, put your price in 305. I don't currently have, I don't currently, actually, I do own some Apple, but I'm not selling it. Um, I don't have it in this particular account. But yeah, so that's what the sell limit is. You'll go in there and you say, hey, I want to sell that price at a certain price point that's above the current price. And then you can choose whether or not you want to have good till close or whether you want to do for the end of the day. And same thing applies, right? Day orders end end of the day, good till close will stay there until you choose otherwise. All right, so that's the limit, that's the market. You have the stop orders. Stop orders are basically orders that are going to execute as market orders when they hit that price or better. So what I mean by that is that you have a buy stop. A buy stop means, you know what, you're not trying to buy limit when it falls down. You're trying to buy it when it goes up. Now, why would you do that? Well, you put a buy stop in if you're trying to catch upward momentum. So let's say right now it's a 288 and you say, okay, well, when it hits 300 or above, I think it's just going to shoot right through it, right? I want to catch the momentum. So you put a buy stop in at 300 and you will hit place order. And basically, same thing applies. Good to cancel or a day. So what that means is that the moment it hits $300 a share, it's going to automatically execute. That's simple. And then you have the, all right, so that's what that is. And then you have the sell stop, and that's self-explanatory. You're already in a stock and you're in the money, or you just bought a stock and it's starting to go against you, and you want to sell out when it hits a certain threshold beneath where you're currently at. So you'll have a sell stop in here, 100. Let's say right now, what is it, 298? So you say, okay, I want to go ahead and have a 280, put that sell stop in there, and then place it. And then there you go. Now, you have what are called stop limit orders. What is a stop limit order? It's actually very easy. It's a stop order, which we've already gone over, but says I want to put a limit on that in case it overshoots significantly where I'm willing to sell out at or buy it. So what does it mean? So if you have a stop limit, right, and you say the okay, so the price is 298.88, and you're like, okay, well right now, and you're like, okay, well right now I want to like, okay, like right now I want to sell out to when it gets to let's say 290. All right, I got a 290 and I got a limit price of 280. Okay, so what does that mean? That means that I want to sell this stock Apple when it falls at 290 or below, but I don't want to sell it if it slips past 280. So what happens a lot of the times with stock markets, particularly with algorithms, is these are highly complex algorithms, and just based on whatever the market conditions are, what'll happen is that a stock price will shoot down super fast. So there'll be thousands and thousands of orders in the queue to execute. You're not the first one in line. You're like number 750th, and it's within milliseconds, but it's significant. And then by the time you go to actually your order gets filled, right? It's actually slipped to 260. And you're like, well, damn. All right, I wanted to sell out at 290 and I got filled at 275 and then it shot all the way back up to 300. You're like, oh my God. So what you do is you put a stop, you do a stop limit. This says when the price hits 290, get me out, right? But if it shoots super fast past 280, keep me in. And only when it comes back up in the 290, 280 range do I want to sell out. That's what a stop limit is. It's to protect you against flash crashes, which will happen. And then it's vice versa with the buy side. So if you're like, hey, I want to buy it at 300, right? I want to buy it at 300, but I don't want to buy it if it goes higher than 310, right? Then that's basically okay. So if it just shoots all the way up way past 300, which very rarely happens, normally it's the other way around with selling. The flash crash go down super fast, then they'll go up. Then you'll go ahead and it'll try to execute you the best price slightly above 300. But if it just shoots all the way past 310, which will never happen, then it won't buy you in until it comes back under that, and then you'll end up getting filled somewhere closer to 310 to 300. So this is to protect you against paying more than what you're willing to pay when you're trying to catch an uptrend. So that's pretty much it, guys. We covered the just to kind of to do the just to kind of do a recap. The market order is to get you in ASAP, right? You don't choose a price. You just you choose your quantity. You hit market order, boom, it executes. Your limit order on the buy side is when you want to buy a stock at a certain price lower than where it currently is at, right? The sell limit is when you want to sell the price higher than where it's currently at. The stop is when you want to buy stock when it's going up higher than where it's currently at, and the sell stop is when you want to sell it lower than where it's currently at. All right. The sell stop limit is when you want to sell it lower than where it's currently at, but you have a limit to where you're willing to sell it, and you won't sell it beneath that threshold. And then the buy stop limit is where you want to buy it higher than where it's currently at, but you have a limit and you don't want to buy it past where past that threshold. All right, that's just like saying, hey, I want to, you want to get a car when it's, well, no, I don't want to use the car analogy because that doesn't quite apply. But it's like when you know it's a good deal, but you don't want to overpay for it or you don't want to underpay for it. So that's pretty much it. That's the synopsis on the different order types. They do have something else that's called a trailing order types, and a trailing order type is I don't actually even know if Webull provides those here. At least I don't see that they do. A trailing order type is when you say, okay, well, I want to buy or sell the stock higher than where it's currently at, but I want to have a trailing stop. So let's say, for example, if you're an Apple at $300, and then it shoots up past that. And you say, okay, well, I want to sell the stock. I want to continue to have it trail up higher past 2 or 3%. What that means is, let's say, like if you're 10%, if you have 10% profit right now, so let's say it's at 330, and you have a 5% trailing stop. The stop is going to actually continue to go up and up and up and follow the stop, the price of Apple going all the way up. But then only when it retracts 5% from its high will it sell you out. And what that does is, the purpose of a trailing stop is so that you can try to lock in as much profit as possible without selling too soon. And the same thing with the selling stop is that you can try to reduce as much loss as possible without selling too late. So hopefully that explains a lot with the different order types. If you guys have any questions, comments, concerns, complaints, gripes, other good stuff, please make sure you leave those comments below. If you haven't already, please make sure that you hit the thumbs up. You hit the like button if you guys found this content valuable. And if you haven't already, please make sure that you hit the subscribe button. Obviously the channel can't grow unless I have you guys to support me. And obviously, in order to do that, I need to provide you guys quality content. And I only know that based on the comments and feedback. And thus far, things have been positive. So please let me know if I've left something out or if it's something that you guys have questions about. In addition to that, if I haven't already mentioned, Webull, which is obviously my primary platform, they are currently offering right now, which is amazing, 2 free stocks by signing up and then deposit into your account. So if you haven't already, I highly, highly recommend you guys sign up for Webull. It's a free platform. It's a great for beginners, and it has a lot of technical analysis as well for people who are advanced. They give you a free stock up to, I think it's $1,200. Realistically, it'll probably be somewhere in the $20 range, but it's free just for signing up. Excuse me, costs you nothing. And then if you want to go ahead and fund your account with at least like $100, which is super minimum, you get another free stock. So super cool. Obviously, you're under no obligation. But if you guys like the content and want to support the channel, then I would definitely recommend you guys sign up below with the link below, and that's where you get your free stock set. So thanks so much. Really appreciate you. Thanks for watching the content. Until then, yep, hit the like and subscribe. Talk to you later. Take care.